are almost in September of 2023, so let's do a bit of a current commercial real estate market update. I know you've heard these words so many times. I'm sick of hearing them, you're sick of hearing them, but I would have to start with interest rates, right? The fact that they have been pushed up and up and up for the past year and a half is really starting to put strain in the marketplace, right? In some ways, it's doing the job that Jerome Powell and Federal Reserve team wanted, to slow inflation, to slow down the economy. So, okay, fantastic, interest rates are up. What does that really mean? Well, borrowing costs are higher, of course. So it costs more money to borrow money from a bank, so loan payments then become higher. Mortgage payments are higher. It's harder to make deals work. And when asset values were just going up and up and up and up for about a decade since the Great Recession, sellers aren't so eager to lower their prices, right? As a buyer, I need to now pay a lower price in order to get the returns that I require. But as a seller, my property value hasn't come down 15% in the past year. There's no way, right? And so there's a huge disconnect right now between seller expectations of what their property values are perceived to be versus what buyers can actually pay for those. That means there's less inventory on the market right now. This has been a slower year compared to previous years for commercial real estate transactions, as many sellers are holding on to their properties instead of listing them for sale if they don't want to take that lower price. So it's almost like, as a real estate investor, we're always looking for a needle in a haystack. It's like a smaller haystack, but with almost like no needles in there this year. So it's just a lot harder to find deals that will actually pencil out with the returns that we need. But that's why we do what we do, right? We keep on moving forward every year. Okay, so let's talk about secondarily banks, right? So they're charging higher interest rates, but it's not just the higher interest rates that are concerning. Banks, especially after the failure of Silicon Valley Bank earlier this year and other banks, and there probably will be more, bank lending is tightened overall. So they're asking for more money down, right? Their loan to value on the loans they're giving is lower than they previously were. They want more money in reserves than the previous amount in previous years. And they're also, so typically banks set their interest rate based on a margin from the prime rate or the 5-year treasury or some benchmark rate. Well, let's say they would typically do 250 basis points above that benchmark rate. So if the benchmark rate were 2%, then they would lend at 4.5%. Well, they've expanded that buffer that they put in. So if they would typically give a 250 basis point spread, this year they might be giving a 300 or even 400 basis point spread. So that they're charging even higher interest rates because of this additional spread. So lots of uncertainty in the banking world right now, tightened lending standards, in addition to the higher prices that sellers still want, it is a tough market right now to find deals to acquire. Now let's talk about the asset side. So you've seen the headlines, commercial real estate's in peril, everything's on fire. Okay. Well, not exactly, right? Yes, office parks are kind of a hot mess right now, as return to work is taking a lot longer than people expect. And in the long term, probably not everybody who was working in office buildings before will ever go back. There is a lot more movement to the suburbs as far as offices are concerned, having those office spaces close to where people live versus the big office parks. Those are not performing very well. There are lots of discounts in that office park space. Central business districts are not doing well, again, as people have been spending more time in the suburbs versus right in downtowns. And of course, that's exacerbated in some cities like San Francisco right now. But even where we live in Raleigh, we're seeing the same thing at a lesser scale in the downtown urban core. So which asset classes are performing very, very well still? Industrial, warehouses, they've been on fire for a long time, and that has shown no signs of slowing down. Retail is still on fire. They just had their lowest vacancy rates for retail properties ever recorded by CBRE in Q2 of 2023 at 4.8%. So retail is still doing very, very strong. Multifamily apartment buildings have great fundamentals still, especially as more people are looking to rent because they can't afford houses. Mobile home parks, they're still in incredibly high demand. So there are lots of asset classes that have really good stories, and there are some locations or asset classes that are not the best right now. Now, if you have an iron stomach and you believe that office will come back, even if it takes until the predictions are currently 2040, then perhaps buying an office space at a 50 or higher % discount off of its high might be a great investment. Speculation, but could be a great investment. You'd be able to fill your space easier because your rents are going to be lower than all of the surrounding properties that paid a higher rate. They can't afford to drop their market rents, whereas you can. I don't have quite that iron stomach for the speculation, so I'll stay away from those office parks. I tend to like more office/retail spaces where it can be like a hair salon or something along those lines, and those are a very different type of asset than an office park. So hopefully this gives you an idea of where the market stands this year, what I'm kind of looking at, continuing to follow these trends, continuing to follow the Federal Reserve's guidance on where they're going to go with interest rates, which right now is unknown. They're going to look at data and determine if they will hold or increase in September of 2023. So that's what we're waiting on right now, and we'll continue to monitor that as we expect interest rates will remain elevated for a couple of years to come. So hopefully this gives you a good idea of the market.